Jonathan Clements is widely regarded as one of America's best financial journalists of the last few decades. Coming up.
So in those initial years, I was focused on writing these heroic profile of star mutual fund managers. And one of the things I noticed about these guys was that even if they had a great story to tell, it seemed they had a great track record and it seemed like they were a great bet for the future, more often than not, they fell by the wayside. There is no way to objectively say whether the stock market is cheap or expensive. All of these valuation yardsticks, these grumpy old men used to talk about, price to book value, price to earnings, dividend yield, all of them have not proven to be reliable ways to know whether stocks are expensive or cheap. What my diagnosis has done is really helped me to focus even more on the day-to-day and enjoying each day that I have. And I would encourage people, even if you don't have a terminal diagnosis, to think about that. What is it you really enjoy in each day?
He was the personal finance columnist for the Wall Street Journal for almost 20 years. He's the author of 10 books, the most recent being My Money Journey, published by Harriman House. His blog, Humble Dollar, is one of the best financial education resources you'll find anywhere online. Jonathan is also a consumer champion and a long-standing advocate for investing in index funds. However, Jonathan has consistently emphasized that money is just a means to an end and not an end in itself. The ultimate goal, he says, isn't to have the most money when you die, but to lead the happiest life you can. Everyone can benefit from watching or listening to my interview with Jonathan. In it, we'll be asking, what's the best way to invest? Why is investor behavior so important? What insurance do we need to have? How does a financial advisor add value? And how should we find a suitable financial advisor? Very sadly, Jonathan was recently diagnosed with terminal cancer. He'll be telling us about his experience and what all of us can learn from it. Believe me, it's worth staying with this one right to the end. I started by asking Jonathan about his early life and how he became a financial journalist.
So I was born in London, out in Twickenham, and when I was 3 years old, my father, who actually was a financial journalist, moved to Washington, D.C. So we, the entire family, moved to Washington, D.C. There, my father worked for the World Bank, and just before my 10th birthday, he was posted to Bangladesh for 4 years, at which point I got shipped off to boarding school in England, and I ended up spending the next 9 years of boarding school in England, which probably explains a lot. And then I had 3 years at Cambridge. I worked in London for a year for a magazine called Euromoney. And then I decided that the standard of living for newbie journalists in the UK was pretty dreadful and that I would move back to the States. I moved back to the New York area, and I've been in this part of the country ever since.
Tell me about your early experiences of financial journalism. In particular, what did they teach you about the industry and that interaction between the financial product providers themselves and journalists like yourself?
So when I was in London, I was working for Euromoney magazine. So we were dealing with international finance. That was a different game. But when I came to the States, I spent the next 3.5 years working for Forbes magazine, and then I moved from there to the Wall Street Journal. At Forbes, I covered mutual funds. And of course, this was the heyday of mutual funds, the star mutual fund managers. They got getting their faces, slathered across the front page of financial magazines. They were treated as superstars, as heroes. And certainly that was, grist for what I initially was writing about. So what is it about, the fund industry and the media that, were so in sync? Well, if you're the media, you need a new story for every publication. If you're a TV station, you need one for every hour. If you're a newspaper, you need one for every day. You need change. And so, the things that you and I favor, Robin, indexing, buy and hold, and so on, that ain't going to fill many monthly magazines. Instead, you need to have something where there's some action. And the fund industry provides that. They provide these star fund managers. Okay, the guy who's on the top this year may be different from the guy who's on the top next year. But if you can take that story and make an exciting piece out of it that grips readers, you will sell that month's magazine or that day's newspaper. So, yeah, there is definitely a symbiotic relationship between the media and the financial services industry.
You became an advocate for simple, low-cost index investing before almost anyone else did. Tell me about the journey you went on to arrive at that conclusion that passive was best.
When I arrived in New York in 1986, there were only a few mutual funds available, maybe half a dozen of them. Vanguard had a couple. I think Fidelity and Dreyfus had a couple, and Dimensional Fund Advisors had its small cap fund. But there weren't a whole lot of offerings, and certainly they were a tiny piece of the mutual fund industry. So in those initial years, I was focused on essentially writing these heroic profile of star mutual fund managers. And one of the things I noticed about these guys was that even if they had a great story to tell at this particular moment, and it seemed they had a great track record, and it seemed like they were a great bet for the future, more often than not, they fell by the wayside. These guys, had great past performance. It didn't mean they would have good future performance. And I couldn't help but notice that, the stars of today weren't necessarily the stars of tomorrow. Also, during this early part of my career, I had the good fortune to meet Jack Bogle, founder of the Vanguard Group. I was impressed, with what he said, and I learned from him. And he became, somebody I was in close touch with for the rest of his life. And without a doubt, he influenced my thinking. When I got to the journal in 1990, I continued to write about mutual funds. But I became increasingly disillusioned with what I saw. And so I started writing more about indexing. And then in 1994, when I got my own column, this was my chance. And I started focusing relentlessly on index funds, pounding away at their virtues. Meanwhile, more and more index funds were becoming available so people could actually build a globally diversified portfolio using index funds. Data was becoming more readily available. We could see how much better index funds were doing compared to the typical actively managed funds. And if you followed the numbers and you followed the logic, there was only one place to go, which was you should be indexing.
Even now, Jonathan, when we read about funds in the financial media, they're far more likely to be expensive active funds than low-cost index funds. Why is that?
What happened? So I didn't come under pressure from, Wall Street Journal management to not write about indexing, but I was under pressure from myself to find something else to say. I didn't want to be the blithering idiot of the Wall Street Journal who wrote the same thing week after week. And so what it led me to do was to explore other areas. And one of the things I discovered was that there was this whole, rich area of finance that wasn't being explored. Issues like when you should claim your government pension, what sort of insurance you ought to have, what sort of home you should buy, and so on and so on. And these were subjects that in general were not the focus of other journalists or of Wall Street. Instead, Wall Street was focused on the thing that made the money, which was getting assets to manage, selling products and getting assets to manage. So that's what they were focused on. They were focused on investing, in these other areas of personal finance were largely neglected. But again, it was a ripe opportunity for journalists who were interested in this area, as with indexing that wasn't getting written about. So these other areas of personal finance weren't getting written about. And, the great thing if you're a journalist is not to have competition. You want to be writing about stuff that nobody else is writing about, because anything you say is going to be interesting. And so what I found over time was, even as I continued to talk about indexing, I drifted away from writing about pure investing stories and starting to focus more on other areas of personal finance.
You've written several times that your view is that people's financial priorities should be about what comes last. And at the end of our working lives comes retirement. So for you, retirement planning, saving for retirement is paramount. Why do you take that view?
Well, first of all, the first thing that everybody should do is to ask themselves, why am I investing? What are the goals that I'm trying to reach? And for the vast majority of people, their number one goal is going to be to pay for retirement. It's the most expensive goal out there. It's the goal that we can't afford not to save for. I mean, you don't necessarily have to buy a house. You don't necessarily have to pay for your kids' college education, but one day all of us will retire, and it's a bloody expensive goal. Moreover, you can get a loan to buy a house. You can take out a loan to pay for your kids to go to college, but nobody's going to give you a loan to pay for retirement. So again, retirement should be your top priority. And to amass the necessary money, you really do need to save for 30 or 40 years. You need those monthly deposits for years and years. And on top of that, you need the help that long-term investing in the financial markets will give you. So yeah, retirement, even though it's our final financial goal, we should always put it first.
Something I've always found refreshing about your investment writing is that you have always focused on the value of staying patient and disciplined and focused on the long term. Why are those things so important?
Well, they're so important in part because there are so many distractions. There is, the TV news. There is the morning newspaper. There is the little, you know, update on where the Dow Jones Industrial Average or the FTSE 100 or the S&P 500 is at this particular moment. There are countless distractions from that long-term focus, and yet we know the value that comes from investing comes from being a long-term investor. That is how you amass serious wealth. You get invested and you let the money compound over the years and the decades. And most of us, have very long time horizons. And I'm not just talking about 20-year-olds. I mean, if you're a 60-year-old, the actuarial tables tell you you might well live another 30 years. That's still plenty of time to make good money in the financial markets. Even at that late stage, most folks are going to be long-term investors, and they should take advantage of that. And the way you take advantage of that is to buy low-cost stock market index funds and just leave them to do the work. Don't get distracted by the media. Don't get distracted by the TV talking heads. Wall Street and the City of London, all the big financial firms, they make money when you act. They want you to do something because action makes money for them. It won't make much money for you, but it'll make a lot of money for them. So to the extent that you sit quietly and you think long term, you're doing the polar opposite of what the big financial firms want you to do. They want you to be active because that's how they make money. You, on the other hand, as an everyday investor, you have this superpower. You have this superpower that you are able to think longer term than the typical financial firm, which, is concerned about their profits this quarter and this year, and they're constantly prodding you to action so that you trade more, you swap to different investment products, whatever it is. Use your superpower. Focus on the long term. Sit quietly and let the financial markets do the work for you.
In fact, the investors who achieve the best returns are those who, in Warren Buffett's words, are greedy when others are fearful. I remember talking to you, for example, in March 2020 during the start of the global pandemic, and you saying, although markets have fallen, we're actually heading very soon for a giant buying opportunity. And indeed, you were right.
I started writing about financial stuff in the mid 1980s. And, back then there were grumpy old men, and there's still grumpy old men, who would look at the financial markets and say, stocks are too expensive, you shouldn't buy. I remember the big market decline in 73, 74, whatever it is. Constantly warning people against taking advantage of falling markets or raising reasons why this time it's going to be different. Even today, there's a phrase that regularly gets denigrated, which is this notion that you should never buy the dip. Don't buy the dip. Don't buy when stuff goes down. You're going to regret it one of these days. It's going to go down and not come back up. I'd say to people, buy the dip. And the bigger the dip, the more you ought to buy. There is no way to objectively say whether the stock market is cheap or expensive. All of these valuation yardsticks, these grumpy old men used to talk about, price to book value, price to earnings, dividend yield, price to cash flow, all of them have not proven to be reliable ways to know whether stocks are expensive or cheap. What counts as expensive or cheap has changed over time. For the everyday investor, the best indication of whether this is a great buying opportunity or not is, and I blasphemous as it sounds, is how much the market has fallen. If the market falls 30% and stocks are at 30 times earnings and history tells you they're expensive, I'd say to you, buy. You know, there's probably the reason they're at 30 times earnings is because corporate profits are depressed because we're in a recession. Whatever it is, don't pay attention to those yardsticks. If the market is down deeply, if the TV talking heads are declaring that the things are going to get even worse, if the pundits are declaring that doom lies ahead, that is the time that you should be buying. And you cannot be distracted by all of this stuff. You simply cannot be distracted.
You've written many times about insurance. What sort of insurance do people really need, and what sort of insurance can they, frankly, manage without?
When it comes to insurance, you need to ask yourself one simple question. What are the financial risks that I face that, if they come to pass, the consequences be so devastating that I need to find somebody to take this risk for me and I need to pay them to do that? So if you're a single individual, your death is like not going to cause anybody financial distress. It may upset your mother, it may upset, your uncle and aunt, but it's not going to cause them any financial distress. So if you're a single individual, you probably don't need life insurance. On the other hand, if you're parents of young children, you need tons of life insurance. You need to think about the financial risk involved and say to yourself, if this insurable risk comes to pass, if I die, if I become disabled, if I crash my car, if I get sued, whatever the risk is, how financially devastating will it be? If it will be financially devastating, you should consider insurance. If it won't be financially devastating, there's no need to buy coverage.
So covering your income in the event of illness or injury could be very important, but paying for phone insurance or extended warranties might not be.
Absolutely. Extended warranties, at least here in the US, are often the biggest source of profits for the manufacturer of that product or the seller of that product. Extended warranties, except in a few cases, are just a complete waste of time. Sure, if you're buying a cell phone for a careless 12-year-old, whether you should be buying a cell phone for a careless 12-year-old is another question. But if you are buying for a careless 12-year-old, yeah, maybe buying the insurance makes sense. But for the rest of us, it really doesn't, because, the chances that you're going to end up being able to use that insurance are small. And if you in a situation where the insurance would be useful, in all likelihood, you can afford to replace that phone out of pocket. So it doesn't make any sense. The same can be said for things like travel insurance. In most cases, travel insurance is hugely expensive relative to the expected benefit. Most people can afford the cost. And I would make exceptions for, you're in your 80s and there's a chance that because of ill health you won't be able to travel. Sure, get the travel insurance. There is a decent likelihood that you're going to use it. For everybody else, it really doesn't make sense.
Jonathan, what are your views on financial advice? How does a financial advisor add value?
The question is, why are you seeking financial advice? And, what are you paying for it? How are you paying for it? And what are you getting advice on? So, in a lot of cases, and this is obviously the reason we end up with financial advisors with bad reputations, in a lot of cases, people are getting sold products on commission that are solely focused on the investment side of the equation and generate huge commissions for the salesperson involved, and often are not what that individual should be buying. So yeah, that's why you end up with advisors with bad reputations. But, if you have an advisor who's a family advisor who's dealing with your entire financial life, that can be useful. But the question is, why is that person useful? And there are two potential reasons, I would say. One is that they have knowledge that you don't have. And you should think about what sort of knowledge we're talking about. And two, you know, how are they helping you beyond the sort of expertise role? So first, expertise. I don't believe this financial stuff is all that complicated. If it was, I certainly wouldn't be talking to you, Robin. I mean, it's simply not that complicated. For a lot of people who are inclined to get on the internet and do some Googling, they can get a lot of the information they need to be decent managers of their own money. But there is an and a reason that people end up using an advisor, which is that they cannot get it done on their own. So I think in many ways, the most useful role for a financial advisor is as a financial coach. It's encouraging people to get started. It's getting them to follow through on the things they ought to be doing, revamping their portfolio, buying the right insurance, getting an estate plan, and so on. And then as they go through life and they either get hit with, bumps personally, or we get financial bumps in the world more generally, they can help people to stay the course and adjust as necessary. That, I think, is the role for a financial advisor as a financial coach, to get people going in the right direction and keep them on track. In terms of turning to a financial advisor because you think that they have some special insight into the financial markets, or they're going to teach you how to beat the market or whatever it is, all that is nonsense. All that is nonsense. But it doesn't mean that a good financial advisor cannot be useful to some people.
For me, Jonathan, the real benefit of using a financial advisor is that the best ones are genuine experts. They keep abreast, for example, of the latest tax changes. And the danger of going down the DIY route is you really could make a big mistake.
I don't disagree with you, Robin, but with a lot of financial advisors, they explicitly say that they will not advise you on tax issues. So if you want help with taxes, and you're going to hire an advisor, make sure that, he or she will indeed talk to you about, managing your tax bill and making sure that you use the right retirement accounts and that you draw down your retirement savings in a tax efficient manner, and so on and so on. But there are a lot of advisors who will not talk to you about such stuff.
So what should people do if they're looking for a financial advisor? What sort of questions should they be asking them?
Well, beyond the experience of the advisor involved, I think a couple of really important questions is, one, how are you going to be compensated? And, I would favor somebody who's going to be charged percent of assets or charged by the hour over somebody who's charging commissions. Because that way, if somebody's charging by the hour or they're charging percent of assets, they're essentially on the same side of the table as you. That removes major conflicts of interest. There still are conflicts of interest, but they're not nearly as large as if somebody's charging commission every time you buy a product. And second, I'd want to find out, what are they going to help you with? Because, you want somebody who's going to help you with more than just your portfolio. I believe that most individuals, could figure out a couple of mutual funds to buy and diversify and have a half decent portfolio. But, as I've learned over my career, there's a lot more to managing money than picking a couple of mutual funds and being well diversified. There are all these other issues. I mean, we've talked about them: estate planning, taxes, insurance, and so on. And you want somebody who's going to help you deal with your entire financial life, who's going to take a holistic view of what you should be doing with your money.
You once wrote that the biggest financial blunders don't come from ignorance, they come from emotions. What do you mean by that? And how can having a financial advisor kind of protect you from those emotional reactions and help you to keep your decision-making rational?
So I think I would encourage folks who are listening to this to ponder two things. One is, what is it that money means to you? What from your background is influencing your financial behavior today? I mean, we are, the sum total of our past experiences. You know, what are you doing with money that reflects, say, some financial trauma that you had early in life? What is it that you do with money that reflects the influence of your parents? I mean, we all grow up, you know, influenced by our parents and other people around us, and it drives a lot of how we manage our money. And in many cases, people are using money in ways that they don't really want to use money. It's just because that's how they've been taught to by life to use money. And so people end up buying expensive cars, even though expensive cars are not important to them. Or they buy heaps of insurance because they were always told, you got to be on, protect yourself against every kind of danger. We are the sum total of our experiences, and it often influences the way we handle money in ways that we're not even aware of. So thinking back on the past financial influences on you is an important exercise to go through. The other thing that, and sort of extension of what I'm just saying is, there's been a lot of research on money and happiness and on how to get greater happiness out of the dollars that we have. And it's worth examining our behavior today and saying, could I tweak the way I use money today in order to have a happier financial life? For instance, we have these basic insights like, commuting tends to be terrible for happiness. You know, people tend to get more happiness from experiences rather than from possessions. Another one I would throw out there is that when we think about using money, in many ways, one of the most important ways to get happiness out of money is not to spend it. Simply having some money and feeling financially secure is probably one of the greatest ways to get happiness from your dollars or your pounds or your euros. Having money so that you feel financially secure is enormously important. So you won't necessarily find happiness at the store, but you may find it by just having a plump portfolio.
As a financial educator and a parent yourself, what would be your advice to other parents? And what can young people do to start building their future financial security?
So the most important financial skill a child can learn, but this is a skill that's important for all of us, is the ability to delay gratification. You know, when you're raising children, you need to help your children learn the ability to delay gratification because that's really the cornerstone of everything. If you can't put off spending money today so that you have more money tomorrow, you're sunk. If you don't have that basic ability, your entire financial life is going to be a struggle. So parents can teach their children to delay gratification in all kinds of different ways. When you tell your kids they cannot have dessert until after they eat their main course, you're teaching them to delay gratification. When you tell them they can't go out to play until they've done their homework, you're teaching them to delay gratification. As parents, you know, it's important to teach our kids to delay gratification. Obviously, we don't want to overdo it. I mean, we don't want our kid to raise kids who postpone joy constantly, but then they need to have some ability to do so in order to navigate this world. And it's not an easy thing to do. We are hardwired to consume right away. I mean, these are the instincts we inherited from our hunter-gatherer ancestors. They survived because they consumed whenever they could. We, in 2024, need to be able to delay gratification. So, yes, learning to delay gratification is number one, and that feeds through to some basic financial behavior. I mean, one is, you got to be careful with credit cards. You don't want to amass a whole lot of credit card debt because you think that you're going to find happiness at the store and spend more than you can pay off when the next statement rolls around. Obviously, that's hugely important. Similarly, you want your kids, when they get into the work world, to start saving for the future, to take advantage of long-term compounding. I mean, kids may not have a whole lot of money to invest, but they have something that's equally valuable, which is time, and they should be making use of that time. If you can get your kids into the adult world and get them to start saving right away, preferably in the stock market, preferably in low-cost diversified index funds, you will be setting them up for a financial life that is more likely to cause them pleasure than pain. And we all want our kids to have a life that is not dogged by financial worry.
Jonathan, you recently had a life-changing medical diagnosis. Tell us briefly about that. And what has it taught you about money and the importance of having your financial house in order?
For folks who are listening to this and don't know, I am age 61. Back in late May, I started to develop some health issues. Specifically, I was having trouble maintaining my balance. And long story short, I got diagnosed with stage 4 lung cancer. I hadn't smoked a cigarette in 37 years. Rather, this was the result of a genetic defect. When my oncologist gave me the news, I was given 12 months to live. I'm hoping to get a little bit more than that, but that was the initial prognosis. So I'm about halfway through my 12 months. As I said, I'm hoping to get a little bit longer. I have thus far weathered the chemotherapy and immunotherapy reasonably well. I'm still active. I don't suffer a lot of fatigue. I've been able to cope with the side effects of the treatment okay. Nonetheless, while I hope for more than a year, it's unlikely that I'm going to get much more than 2 or 3 years. And so one of these things that has prompted me to do is to get my financial life in good order. Trust me, there is nothing that focuses the mind quite like knowing that you may not be around that much longer. And for most of us, our thoughts are going to turn toward our family and making sure that things are okay after our death. And when you start to think about that and how you're going to make things easy for your children or easy for your spouse, it's amazing how much needs to be done. If I had simply keeled over and died in May of this year, I hate to think how much difficulty my family would have had in settling my affairs. And trust me, Robin, my financial life is not that complicated. I have all my investments at a single firm. I use a single bank. I don't have multiple investments. I'm reasonably well organized, and yet, I have spent months straightening out my affairs. I had tax returns going back to 1986. I've thrown out all of them except for the last 7 years. I had old financial statements. I had boxes of papers from when I was in college and so on. I've spent months clearing out this stuff, and it's relatively easy for me to do. It would have been awfully hard for my family to do because they wouldn't have known what was important and what was not. They would have looked at this stuff and said, why did my husband keep this? Why did my dad keep this? Was this important? Was it not? If you want to do your family a favor, you need to make those decisions and throw that stuff out. Go down to the basement, look at all the crap you have. And trust me, the reason it's in the basement is because it is crap. If you really cared about it, it wouldn't have ended up there. And most of it can be thrown out. So go down there, pull out those boxes, go through them, and get rid of them. The other thing I would just mention is that, after death, it becomes difficult to close financial accounts. Whether it's a credit card or a bank account or a financial account, there's a good chance that the financial firm involved will want to, get a death certificate. They will want to know all the details before they go ahead and close this account. Obviously, in this era of scams and fraudsters, they're going to take extra care before they do any of this stuff. So I've tried to move ahead and make these changes now so that my family doesn't have to deal with all the nonsense of closing financial accounts after I'm gone. And finally, Roman, just one other thing, which is, in our family, All the utilities are in my name: the electricity, the telephone, the internet, the gas, the water bills. Similarly, all the insurance policies were in my name. The auto insurance, the homeowner's insurance, the umbrella liability insurance. It's much easier for me to pick up the phone and call up and say, "Hey, I'd like you to move these into my wife's name." It's much easier for me to do that while I'm alive than it will be for Elaine to do it after my death. So I've been trying to straighten out all of that stuff so that, after I'm gone, whatever fond memories they are not tarnished by having to deal with all of this ridiculous paperwork.
In your book, How to Think About Money, you wrote this: "The ultimate goal isn't to have the most money when you die, but rather to lead the happiest life you can." I assume that's still very much your philosophy.
A lot of people say, well, you're going to die. You have accumulated all this money for retirement that you're not going to have. You might as well go on a big spending spree, travel first class, go to the finest restaurants, get, front row seats at the concert and so on. And what I would say is that getting a diagnosis like this really brings into sharp focus what's important and what brings happiness. And, I have no desire to start living high on the hog. I want my family to be okay. I'm not going to spend like crazy because I want them to be financially okay after I'm gone. Knowing that brings me a lot more happiness than, going down to the local concert hall and sitting in the front row for whatever's coming up tonight. Similarly, what I've discovered, I knew before, but what's really been re-emphasized to me is how much pleasure is in the little things, in that, that first cup of coffee, taking a walk and feeling the sunshine on my face, taking a walk and seeing nature, talking to friends, doing the work that I love. These things cost very little or nothing at all, and yet they're the things that bring me the greatest pleasure. What my diagnosis has done is really helped me to focus even more on the day-to-day and enjoying, each day that I have. And I would encourage people, even if you don't have a terminal diagnosis, to think about that. What is it you really enjoy in each day? And not only focus on those things, but savor those experiences. So difficult to get distracted by silly worries, by the financial markets, by the latest political turmoil, whatever it is. Forget that stuff. Think about what you enjoy. Focus on those things and savor those moments because, tomorrow's promised to nobody. And this world is a wonderful world. There is so much happiness to be had if we focus.
Jonathan, you've been an inspiration to me throughout my career. You've also helped many, many people to achieve better financial outcomes than they otherwise would. Thank you for everything you've done, and thank you for talking to us.
Oh, Robert, it's always a pleasure to talk to you. Thanks so much for having me on.
That was the financial journalist and author Jonathan Clements. I can highly recommend his blog, Humble Dollar, and his books. We are hugely grateful to Jonathan for his time and to our sponsor, Index Fund Advisors. Goodbye.